I like my clients to be in a position to where they can win no matter what. And in order to do that, you have to be in dividend paying stocks. What that allows you to do is that allows you to get paid to wait. The next 5 or 10 years may be choppy in the market. There's a lot of analysts out there that think that over the next decade, it could be flat. We've seen lots of 10-year periods in the market where the period's flat. And if you're in growth stock, then you're flat. But if you're in dividend stocks, at least you can dollar cost average those dividends back in so that you're getting paid to wait. You have the ability to use that dollar cost averaging math to your advantage, regardless of whether the market stays flat. And I think that's a great strategy for if you're younger.
Now, if you're older and say, you're looking ahead to retire for 2024, not knowing what's going to happen in terms of Fed action there, how does that approach change?
Yeah, great question. And that's a question that we get all the time at Providence Financial because we do specialize in working with retirees. And the answer is this. I want my clients, my retired clients, to be invested in investments that are going to give them interest and dividends to be able to live off of. A lot of people don't understand interest and dividends. You can spend your interest and dividends every single year without ever having to cannibalize your principal. If you're taking out 4%, let's say, of your portfolio, which is a common number, if you're invested in growth stocks or mutual funds, you're having to sell shares, which means next month you got to sell more shares, and next year you have to sell more shares. And in a flat market, that's just horrible. You're cannibalizing your principal. Whereas if you're living off of interest and dividends, you're not having to cannibalize your principal. You're never having to worry about running out of money. So for the income that they need from their portfolio, I want them to set aside enough money to live off the interest and dividends. And once they've got that covered, their income coming from interest and dividends, then they can play with the rest of it. They can take the rest of it and put it into some other things that give them potential for growth. So that's how my retired clients are playing it. I think that makes sense for most retirees out there.
And then for those who are perhaps mid-career or early career, who have a longer time horizon here, you're looking at things like inflation, you're not sure how long it's going to be this high for. How do you weight your portfolio differently if you're, say, mid-career or just starting your career?
Yeah, great question. You're certainly going to weight it more heavily towards stocks. I think the dividend stocks, as mentioned before, is probably the great way to go. But you could also go a little more heavier into bonds at this point with the income because you've got that capital appreciation. So the typical 60-40 portfolio is something that has had a lot of controversy around it. Does it work? Does it not work? I would suggest that if someone has 20 or 30 years to go in retirement, my recommendation in the past is generally going to be 80 or 90% dividend paying equities. I think over a 30-year period, that's where you're going to get the most bang for your buck. And because you have such a long time horizon, all the odds are in your favor. But today, because yields are so high, because bonds have been beaten down and are at low levels, I think a 60-40 for now even works for the younger person, with the idea that when the Federal Reserve lowers rates, and bonds increase in value, then you can reallocate back to a higher allocation of dividend-paying stock at that point.
And Anthony, obviously, as we look at the economic picture, we're seeing, wage growth starting to moderate a little bit. The very tight job markets, starting to see some cracks there, and people are having to prioritize in different ways. I mean, according to statistics, about 57% of people last year don't even have a financial advisor. How do you start structuring your portfolio when you're sort of looking at some of these changes in the workforce? And how do you adapt it as you see some of these changes from the Fed and from the economy?
Yeah, so I think that the Fed, and all the odds are that the Fed's going to hold steady this next FOMC meeting. And I even think there's a good possibility that they hold steady in the following meeting after that, but we don't know. The fact is that if you have a long time horizon, what you need to understand is that it doesn't matter what they do. If your strategy is dollar cost averaging, and that's just buying the same thing over and over again, and if you're dollar cost averaging, keep doing that. Don't change. You don't want to be in a position to where the market volatility spooks you and now you deviate from your plan. But in order to do that, you have to have a plan. And your plan cannot be that the market's going to go up 8% a year for the next 5 years or 10 years. That's not a plan. The plan has to include what happens if this, what happens if this. That's the whole point of the plan. If you plan to drive from California to Florida and the road is closed, you have to know how you're going to deviate. You don't make the decisions at the moment the market corrects or the moment we go into a recession. That all has to be built into the plan ahead of time. No good decisions happen when you panic. And if you have a plan and you know what you're going to do ahead of time, I'm going to suggest that you don't panic, because whatever you do is probably going to be wrong.